You are watching the exact moment the tectonic plates of global wealth are fracturing. Right now, as we navigate 2026, we are not just looking at a market correction. We are not looking at a standard macroeconomic cycle. We are standing at ground zero for the largest, most aggressive transfer of capital in human history. Over the next 2 decades, $84 trillion is shifting hands. But forget the next 20 years. The velocity of this transfer has violently accelerated this exact year. If you are managing a high net worth portfolio, if your capital is deployed in traditional equities, real estate, or standard fixed income vehicles, you are playing a game with rules that expired 24 months ago. The institutions know it. The family offices know it. And today, you are going to see exactly the data they are using to front-run the retail market. Let us look at the raw data. Currently, the baby boomer generation controls roughly 50% of all wealth in the United States alone. That's a staggering $78 trillion. As they transition into the latter stages of retirement and estate planning, we are seeing a massive liquidation of long-held assets. We're talking about the unwinding of decades-old equity positions, the forced selling of prime real estate to transition into trust-managed liquid assets, and a fundamental rewiring of corporate ownership. This is not just a generational handoff, it's a systemic liquidity shock. When $84 trillion moves, it doesn't just flow smoothly from one bank account to another. It triggers taxable events. It forces capital reallocation. It alters the foundational architecture of supply and demand across every major asset class. If you think the S&P 500 or global equities are pricing in the sheer volume of forced liquidation coming from demographic aging, you are mathematically incorrect. Look at the institutional footprint. Over the last 18 months, Tier 1 liquidity providers and sovereign wealth funds have not been buying the dip in traditional large-cap equities. They've been quietly executing a massive pivot. They are actively restructuring their portfolios to capture the friction of this wealth transfer. They are moving into private credit, hard assets, and hyper-specific alternative investments that are insulated from the demographic sell-off. Why? Because the smart money understands that when a massive cohort liquidates simultaneously, the traditional 60-40 portfolio doesn't just underperform, it acts as a wealth incinerator. Let me give you a specific metric. In Q4 of last year, the velocity of capital moving out of standard retail brokerage accounts and into trust-managed, tax-advantaged holding structures increased by 400%. That's money leaving the active market and being locked away. It drains liquidity, and in a low liquidity environment, volatility is not just a risk, it becomes a weapon used by institutional algorithms to strip capital from the uninformed. You are likely listening to this because you have capital to protect. You have built wealth, or you are managing family assets, and you are sensing the friction in the markets. You see the geopolitical instability. You see the inflationary pressures that simply refuse to die. You see central banks trapped between defending their currencies and monetizing their impossible debt loads. But those are the headlines. Those are the distractions engineered for the mass market. While the retail investor is obsessing over the Federal Reserve and their next quarter-point move, or the latest earnings beat from a mega-cap tech stock, the foundation of the market is being quietly rewired. The $84 trillion transfer is creating localized bubbles of hyperinflation in certain asset classes and violent deflation in others. If you are positioned on the wrong side of this demographic wave, you will not just lose purchasing power, you will become the exit liquidity for the ultra-wealthy. So, How do you position yourself? How do you build a firewall around your portfolio when the greatest capital migration in history is violently reshaping the landscape? Over the next hour, we are going to dissect the exact blueprints being used by the world's top 1% of family offices. We will look at the exact sectors that will capture this flowing capital, and more importantly, the legacy assets you need to strip from your portfolio before the end of the year. We are going to look at the cold, hard mathematics of wealth preservation in 2026. No narratives, no media spin, just the data. But before we map out the solution, we need to address the elephant in the room. There's a reason this wealth transfer is accelerating right now. It's not just demographics. Deep inside the plumbing of the global financial system, specifically hidden within the overnight repo markets and the collateralized debt obligations of Tier 1 banks, a massive structural fracture has just appeared. The institutions are rushing to move their capital, not just to pass it to the next generation, but because they are trying to escape the blast radius of a localized credit event that the mainstream financial media hasn't even noticed yet. If this hidden tripwire snaps before your capital is repositioned, the $84 trillion wealth transfer will not matter, because your portfolio's collateral could be wiped out in 72 hours. Let me show you exactly what's hiding in the balance sheets.
The hidden fracture in the credit markets is the catalyst. But where is the capital actually running to? To understand the survival strategy of the ultra-wealthy in 2026, you have to understand a concept called sovereign arbitrage. Institutional money is not moving into cash. Cash is a melting ice cube in an inflationary regime. Instead, they are executing a violent rotation out of high-multiple, speculative growth stocks and pouring billions into heavily discounted, cash-flowing global monopolies. We are talking about infrastructure. We are talking about the physical layer of the global economy. The smart money is abandoning companies that promise future earnings. They are buying companies that control the underlying commodities, the energy grids, and the digital pipelines required for human civilization to function. They are hunting for extreme capital efficiency and unbreakable monopoly moats. Let us break down the first major pillar, the energy and utility choke points. While retail investors chase software valuations, family offices are aggressively accumulating positions in state-backed energy titans. Look at Aramco in Saudi Arabia or CNOOC in China. These are not just oil and gas producers. They are sovereign instruments with massive dividend yields and price-to-earnings ratios that have been artificially compressed by Western ESG mandates. The institutions are buying them at a historic discount. But it goes deeper than fossil fuels. It is about the electrification of everything. Look at companies controlling national utilities like DY in Dubai, water and electricity. These entities operate with absolute inelastic demand. Inelastic demand means that no matter what the macroeconomic environment does, no matter how high interest rates go, consumers and corporations must pay their bills. This provides a guaranteed inflation-adjusted free cash flow yield. In a volatile market, a high, secure dividend is not just income, it is a mathematical shock absorber for your portfolio's total return. Now, let us connect this to the most explosive trend of our decade, AI. The narrative sold to the public is to buy the semiconductor designers and the software platforms, but the institutions know that AI has a severe physical bottleneck. Data centers require unfathomable amounts of electricity, cooling systems, and physical infrastructure. You cannot compute the future without copper. You cannot build the hardware without silver and gold. This is why we are seeing a massive rotation into Tier 1 mining and basic materials. Giants like Rio Tinto and Zijin Mining. These companies control the veins of the earth. The capital expenditure required to open a new copper mine takes 10 to 15 years. Supply is physically capped. Meanwhile, demand from the AI revolution, electric vehicle grids, and national security stockpiling is going vertical. When inelastic, capped supply meets hyper-accelerated demand, the underlying asset is completely repriced. The smart money is not buying the AI software. They are buying the copper and the power plants required to turn the servers on. The third pillar of this great rotation targets absolute defensive yield in global consumer and telecommunications monopolies. Institutions are stress-testing their portfolios against a severe recessionary environment. They need assets with a low beta. Beta measures a stock's volatility relative to the broader market. A low beta means the asset ignores the panic. They are accumulating shares in fortress balance sheet companies like Procter & Gamble, Johnson & Johnson, and massive telecom operators like China Mobile. Why telecom? Because data is the new utility. You will cancel your streaming subscriptions, you will stop eating out, but you will not disconnect your internet or your mobile data. These telecommunication giants generate enormous, predictable cash flows, which they return to shareholders through massive dividends. They are effectively functioning as high-yield bonds, but with the added protection of price appreciation as institutional capital floods into their shares for safety. Finally, we have to look at the financial plumbing itself, the rotation into emerging market and Gulf state banking. Western banking systems are heavily burdened with depreciating commercial real estate debt and underwater sovereign bonds. But if you look at the Middle East, specifically Saudi Arabia, the UAE, and Qatar, you see a completely different reality. Institutions are quietly building massive positions in financial fortresses like Al Rajhi Bank and Qatar Islamic Bank. These institutions are operating in regions flush with capital surpluses from the energy trade. They have exceptionally high Tier 1 capital ratios, which is the core measure of a bank's financial strength from a regulator's point of view. They are highly liquid, incredibly profitable, and they are immune to the localized credit crises brewing in Western markets. By holding these specific global equities, high-net-worth investors are effectively shorting the debt-heavy Western system and going long on the cash-rich, commodity-backed economies of the future. So, we've mapped the infrastructure: energy monopolies, AI metals, defensive telecom, and cash-rich global banks. This is the exact basket of $84 trillion wealth transfer is rotating into. But there's a catch. You can't just blindly buy these assets today and expect to be insulated. Because the institutional rotation I just described, it relies on one very specific geopolitical assumption remaining intact: a single, highly concentrated geopolitical risk involving the global maritime shipping lanes. If this bottleneck closes, the value of those resource monopolies will skyrocket, but your ability to execute a trade or even access your brokerage capital might be frozen entirely.
The maritime bottleneck we just exposed is the exact reason why institutional capital is ruthlessly prioritizing one specific sector above all others: energy sovereignty. We are not talking about speculative green tech startups. We are talking about the undisputed, state-backed titans of global energy infrastructure. The $84 trillion wealth transfer is moving aggressively into entities that control the physical extraction, refinement, and distribution of baseline power. Look at the underlying architecture of the Gulf and Asian energy markets. Institutions are heavily allocating into sovereign-level monopolies like Saudi Aramco and ADNOC Gas. These are not standard corporations subject to the whims of a localized recession. They are the financial lifeblood of entire nations. How do they generate entirely recession-proof cash flow? It comes down to toll road economics and long-term supply contracts. When a company like ADNOC Gas or PTTEP in Southeast Asia extracts and processes natural gas, they are not selling it on the volatile spot market hoping for a good price. They are locking in 10, 20, and 30-year purchase agreements with sovereign governments and massive industrial complexes. The cash flow is mathematically guaranteed. Whether the global equity markets are up 20% or down 20%, nations must power their grids. But the smart money goes even deeper into the supply chain. They are buying the midstream and downstream infrastructure. Consider giants like Sinopec Engineering in China or specialized refining entities like Luberef. These companies operate the pipelines, the processing plants, and the chemical refineries. They do not care about the daily price of a barrel of crude oil. They get paid a fixed fee for every single barrel that flows through their pipes and every chemical compound they synthesize. This creates an impenetrable moat of free cash flow. It is absolute stability. And in a macroeconomic environment where inflation is silently destroying the purchasing power of fiat currency, these infrastructure monopolies pass their increased costs directly onto the consumer. They are the ultimate inflation hedge. They generate billions in surplus cash, which they distribute to shareholders through aggressive high-yield dividends. If your portfolio does not hold the companies that power the earth, you are holding the companies that are completely at their mercy. Now, we must pivot to the second sector absorbing this massive wealth transfer, the AI and tech backbone. The media wants you to focus on the consumer-facing chatbots. The ultra-wealthy are focusing on the physical compute layer. AI is not a software revolution, it is an industrial revolution, and industrial revolutions require massive physical infrastructure. To run a single large-scale language model, you need tens of thousands of specialized processors running simultaneously inside colossal data centers. These data centers are the factories of the 21st century. This is why capital is flooding into the foundational layers of technology. We are looking at the massive capital expenditure cycles of global giants like Microsoft and Google. We are not buying them for their search engines or their office software. We are buying them because they are constructing the proprietary global network of data centers that the entire digital economy will be forced to rent. They operate as digital landlords. If a Fortune 500 company wants to deploy AI, they must pay rent to these backbone providers. It is a recurring, infinitely scalable revenue model. And we must look at the hardware deployment on a global scale. Companies like Xiaomi are positioning themselves to dominate the hardware distribution in emerging markets, capturing the physical endpoints where AI meets the consumer. But here is the most critical data point, the point where the energy sector and the AI sector violently collide. Data centers are the most energy-dense structures ever built by humanity. You cannot build the digital future without an unfathomable amount of baseline electricity. AI requires natural gas, it requires nuclear power, it requires the exact energy infrastructure we just analyzed. The companies that build the data centers are currently signing multi-billion-dollar, decade-long contracts with the companies that generate the power. It is a closed-loop system of capital generation. The cash flow is locked, the dividends are secured. This is the hidden portfolio of the top 1%. So, how do you actually execute this strategy? You cannot access this level of global diversification using a standard restrictive retail brokerage account. If you want to protect your wealth and capture the high dividend yields of Saudi Arabian energy monopolies, Chinese infrastructure giants, and Tier 1 global technology platforms, you need institutional-grade market access. You need to open an account with a platform that routes your capital directly to the global exchanges. You must position your capital in platforms like IBKR for unrestricted global market access, or leverage robust institutional interfaces like InnovestX or Dime, depending on your geographic jurisdiction and capital requirements. Do not wait for your local wealth manager to pitch you a watered-down, high-fee mutual fund. You need to directly own the underlying shares of these global monopolies. Open the account, fund it, and begin executing the rotation. But before you deploy a single dollar into these global equities, you must understand the final piece of the macroeconomic puzzle. Even the greatest global monopolies are still priced in fiat currency. What happens when the underlying denominator, the actual currency you are using to measure your wealth, begins to experience a sovereign-level systemic failure? To truly bulletproof your legacy, you must step outside the fiat system entirely. Next, we are going to look at the apex predator of hard assets. We are going to look at Bitcoin and the exact mathematical reason why sovereign nations are quietly accumulating it before the global debt market fractures.
We have established the physical infrastructure. We have mapped the energy monopolies and the digital backbone. But now, we must confront the apex predator of the modern financial system, BTC. The mainstream narrative has convinced the retail investor that this is the ultimate safe haven. They have been indoctrinated with the concept of diamond hands. They believe that holding blindly through the macroeconomic volatility will guarantee them generational wealth. This is the most dangerous psychological trap in the history of capital markets. You are being conditioned to hold your asset completely static, while the most sophisticated algorithmic trading desks on Earth actively harvest your liquidity. If you believe the underlying market structure of BTC today is the same as it was 4 years ago, you are walking into a mathematical slaughterhouse. Let us look at the empirical data. The introduction of the spot ETFs did not democratize the asset. It captured it. The order books are no longer controlled by early adopters or ideological purists. They are entirely monopolized by Tier 1 asset managers, sovereign wealth desks, and high-frequency trading algorithms. These entities do not hold for the culture. They do not care about the decentralized ethos. They view BTC purely as a high-beta liquidity sponge. When you proudly refuse to sell, when you lock your capital in cold storage and refuse to realize your gains, you are performing the exact function the whales require. You are artificially constraining the float. You are removing supply from the market, which allows institutional market makers to violently manipulate the price action with a fraction of the capital they would normally need. You are not a sovereign individual. You are unpaid security for the institutional exit strategy. And this brings us to the most critical mathematical event on the horizon, the April 2028 halving. The entire retail sector is heavily over-leveraged on the assumption that the 4-year cycle is an unbreakable law of physics. They are mathematically certain that holding through 2026 and 2027 will automatically reward them with a parabolic blow-off top in 2028. But the smart money knows that when an entire market anticipates a specific timeline, the trade is already dead. We are looking at a localized macroeconomic cliff that will materialize long before the April 2028 block reward reduction. Central banks are preparing to execute a synchronized global liquidity drain to combat a second wave of structural inflation. When the overnight repo markets dry up, institutions will not sell their physical energy infrastructure. They will not sell their gold. They will liquidate the highest beta asset on their balance sheets. They will aggressively dump paper BTC onto the market. You have to understand the mechanics of collateralized rehypothecation and the synthetic paper markets. The BTC you think is safely isolated from the traditional financial system is now deeply entangled in billions of dollars of derivative contracts and ETF structures. The whales do not need to sell physical tokens to crash the market. They use the futures markets. They write naked short contracts. They weaponize the options chains to pin the price exactly where it causes the maximum psychological pain for the retail holder. When the algorithmic selling begins, it will not be a standard organic correction. It will be a cascading, engineered liquidation event. It is explicitly designed to trigger every stop loss, every margin call, and every psychological breaking point in the retail ecosystem. The price action will become mathematically incomprehensible. The charts will look entirely broken. You will see violent, face-melting rallies followed immediately by gut-wrenching 50% intraday crashes that defy all on-chain metrics. You will read coordinated, highly targeted reports of sovereign states unexpectedly offloading massive dormant wallets. The media will run synchronized campaigns questioning the cryptographic integrity of the network itself. They will introduce legislative panic. They will talk about global coordinated tax penalties on unrealized crypto gains. The confusion is the weapon. The anxiety is the objective. Think deeply about the timeline between now and the end of 2027. The market makers have mapped your psychology. They know that every single retail investor is looking at the April 2028 halving as the ultimate finish line. They know exactly where your mental stop loss is. So what is the most mathematically profitable move for a trillion-dollar asset manager? It is to create a multi-year, agonizing sideways grind that slowly bleeds the premium out of the market. It is to make the asset completely uninvestable for the average person. They will force you to watch as the traditional infrastructure monopolies, the energy grids and telecommunication giants we just discussed, distribute massive compounding dividends quarter after quarter. They will force you to watch as those who rotated into hard physical assets sleep perfectly at night, while you stare at a screen at 3 in the morning, wondering why your decentralized asset is correlating directly with the collapse of the tech sector. Doubt will become your permanent state of mind. You will begin to wonder if the halving cycle is fundamentally broken. You will wonder if the ETF approval was actually a Trojan horse designed to kill the volatility that made the asset attractive in the first place. You will start to rationalize selling, just to secure a small profit, just to stop the psychological bleeding, just to reposition before the perceived crash. The institutions want you paralyzed by fear. They want you questioning your own sanity as the asset bleeds out month after month. They need you to surrender your tokens. They need you to sell out of pure, unadulterated exhaustion right before the global liquidity cycle actually turns. They need you to abandon your position before April 2028 so they can buy your capitulation at a severe discount. The diamond hands narrative is a psychological operation designed to make you the ultimate bag holder. The game has fundamentally changed. The volatility is no longer organic. It is synthetically weaponized to extract your capital. If you do not have an active mathematical strategy to navigate the synthetic manipulation approaching in the next 18 months, holding BTC might not be your path to sovereignty. It might be the exact mechanism that destroys your wealth. The question is not whether the halving will happen. The question is, will you survive the psychological warfare designed to separate you from your asset before we even get there?
The psychological warfare surrounding BTC is meticulously designed to blind you to the actual mathematical rotation happening in the background, while the retail market is hypnotized by the promise of a 2028 halving supercycle. The most sophisticated capital on Earth is executing a quiet, ruthless exit strategy. They are liquidating their speculative digital holdings, and they are doing it right now. You must ask yourself a highly uncomfortable question. If BTC is the ultimate pristine collateral, why are Tier 1 institutions aggressively pumping the narrative, yet systematically reducing their net long exposure in the derivatives markets? The answer is structural liquidity. They need a massive, hyper-engaged pool of retail investors to absorb their massive sell orders. Your unwavering conviction, your refusal to sell, no matter how erratic the price action becomes, is the exact psychological mechanism that allows a sovereign wealth fund to offload $1 billion of crypto without instantly crashing the order book. You are not participating in a financial revolution. You are providing the exit liquidity for the global elite. Part 24. But where is that extracted capital going? It is not moving to cash, and it is certainly not moving back into speculative tech software. The smart money is taking the US dollars they extract from your diamond hands, and they are executing a massive rotation into the tangible, dividend-paying global monopolies we mapped earlier. They are trading abstract digital scarcity for absolute physical sovereignty. They are buying entities like Saudi Aramco, China Shenhua, and CNOOC. Look at the underlying logic. BTC produces zero yield. It generates no cash flow. In a macroeconomic environment where the cost of capital is elevated, holding a non-yielding asset that is subject to extreme, synthetically engineered volatility is a mathematical liability. Meanwhile, the state-backed energy and infrastructure titans are trading at historic discounts. They are generating tens of billions of dollars in free cash flow every single quarter, and more importantly, they are distributing that capital directly to their shareholders through massive, unbreakable dividend yields. Part 25. Let us run the comparative mathematics between now and the much-anticipated April 2028 halving. The retail investor believes that holding BTC through the coming localized credit event is a badge of honor. They are prepared to endure a 30, 40, or even 60% drawdown in the blind hope that the block reward reduction will magically repair their portfolio 2 years from now. This is financial suicide. While you are suffering through a multi-year, mathematically engineered crypto winter, the institutional capital that sold you the top is quietly compounding their wealth in global infrastructure. They are holding companies like China Mobile and ADNOC Gas and PTTEP. These entities are effectively immune to the liquidity crises of the Western banking system. They possess absolute pricing power over the global supply chain. If inflation spikes, they raise the cost of their energy and telecommunications data. The cash flow increases. The dividend increases. Your purchasing power is protected in real time, every single quarter. By the time the 2028 halving actually arrives, the institutional portfolio holding these physical assets will have generated massive compounded returns through dividends alone, completely independent of the underlying stock price. You, on the other hand, will merely be hoping to break even on an asset that has been aggressively manipulated by algorithmic trading desks. Part 26. This is the hidden systemic risk that the mainstream crypto media refuses to discuss, the risk of absolute opportunity cost combined with catastrophic illiquidity. The institutions know that a synchronized global liquidity drain is imminent. When the sovereign debt markets finally buckle, the margin calls will not be paid in digital tokens, they will be paid in US dollars. And to get those dollars, the major market makers will systematically liquidate the most liquid, high-beta asset on their balance sheets. They will crash the BTC market with a velocity that will completely shatter the structural support lines. It will not happen after a long, drawn-out bear market. It will happen on a random Tuesday, without warning. You will wake up, check your portfolio, and realize that the algorithms have wiped out 50% of the market cap while you were sleeping. The exchanges will experience sudden, unexplained outages. You will be completely locked out of executing a trade. And as you sit there, watching your decentralized wealth evaporate, the major family offices will be collecting their quarterly dividend checks from the physical infrastructure companies that keep the lights on. Part 27. You have been sold a narrative of inevitability. You have been told that time in the market is the only variable that matters. But in a period of structural wealth transfer, holding the wrong asset is exactly how wealth is transferred away from you. Do not let your ideological attachment to a digital network blind you to the brutal reality of global capital flows. The smartest mathematical move you can make today is to front-run the institutional liquidation. You must critically evaluate every single dollar you have locked in speculative crypto assets. You need to capture your capital, realize your gains or cut your impending losses, and remove your wealth from the blast radius of the algorithmic slaughterhouse approaching before 2028. Every day you wait, every day you tell yourself to just hold on a little bit longer, you're giving the smart money another 24 hours to secure their exit at your expense. Sell the abstract, buy the physical. Rotate into the dividend-paying monopolies that actually run the planet.
Breathe. Let the engineered panic of the algorithmic crypto markets completely fade. You do not have to live in a state of perpetual anxiety, watching your portfolio violently swing at 3 in the morning. There is an antidote to the synthetic volatility. It is a mathematical certainty. It is the exact strategy the world's most enduring family offices use to preserve and multiply generational wealth. We call it the dividend snowball. It is not about timing the perfect top. It is not about staring at derivative charts hoping for a synthetic halving cycle to save you. It is about aggressively accumulating cash-flowing physical monopolies and letting the brutal efficiency of compound interest do the heavy lifting. When you rotate out of speculative digital assets and into global blue-chip infrastructure, you immediately stop playing defense. You step out of the casino and you step into a system of absolute, predictable financial physics. You become the house. The mechanics of the dividend snowball are beautifully simple, yet mathematically devastating to inflation. To accelerate your wealth and hit aggressive, uncompromising financial targets by 2030, you do not just buy random dividend stocks. You engineer a biannual dividend capture system. You divide your target portfolio into 2 distinct, mathematically optimized operational groups. Group 1 consists of physical infrastructure and energy titans that systematically distribute their massive yields between January and June. Group 2 is comprised of telecommunication and basic materials monopolies that pay out their cash flows between July and December. By staggering these acquisitions, you create a relentless, continuous loop of incoming capital. You take the immense cash payouts from the end of the year and you immediately deploy them into the undervalued assets of Group 1. Then, you take the mid-year distributions and feed them directly into Group 2 to capture the next cycle. You are creating a compounding machine that cannot be stopped by a localized credit event or a BTC flash crash. Look at the exact instruments you are loading into this snowball. We are talking about impregnable, debt-resilient assets. You are buying sovereign-backed energy giants like Saudi Aramco and CNOOC. You are acquiring the absolute baseline utilities of emerging markets like DEWA in Dubai and foundational energy producers like PTTEP. You anchor the portfolio with the physical materials required for the AI revolution, like Rio Tinto and Zijin Mining, alongside unstoppable cash flow fortresses like China Mobile. These are not software companies that might be obsolete in 5 years. These are the physical pillars of human civilization. They generate tens of billions in free cash flow, regardless of what the Federal Reserve does. When you hold these assets, you are not speculating. You are collecting a guaranteed inflation-adjusted toll on global economic activity. Let us look at the raw mathematical projections. Let us look at what actual wealth generation looks like between now and 2030. If you take the capital you are currently risking in highly leveraged, non-yielding digital tokens and you deploy it into this global infrastructure basket, the geometry of your wealth fundamentally changes. Let us assume a highly conservative average yield of 6 to 8% from these Tier 1 global monopolies. In year 1, the dividends provide a massive injection of liquidity. But you do not spend it. You execute the snowball. You relentlessly reinvest those biannual payouts back into the principal. By year 2, your new, larger principal generates an even larger dividend. The mathematics begin to curve upward. You are now acquiring entirely new tranches of global shares without deploying a single dollar of active capital. The companies are effectively buying more of themselves for you. By the time we reach 2030, the exact timeline when the crypto market will likely be decimated by structural liquidity drains, your portfolio will have reached critical mass. The compound interest will have entirely eclipsed your original principal. You will have built an unbreakable, self-sustaining financial ecosystem. The psychological relief you will experience is absolute. You will sleep soundly knowing that your family's legacy is secured by the copper, the oil, the water, and the data networks that physically power the earth. You will watch the synthetic crypto markets burn from the safety of a fortress built on compounding cash flow. You will never again have to check your phone in a panic. The anxiety of the diamond hands trap will be replaced by the quiet, unshakable confidence of true ownership. But to build this fortress, you must execute immediately. You cannot deploy this global strategy on a restricted, high-fee local retail platform. You must route your capital through institutional-grade global brokers. Whether you are utilizing IBKR for complete unfiltered global exchange access or leveraging sophisticated regional platforms like InnovestX or DME, you must position your capital right now. The infrastructure is ready. The $84 trillion wealth transfer is actively seeking these exact assets. Liquidate the speculative. Buy the physical. Start the biannual snowball and take total, absolute control of your financial destiny today.
To fully deploy the dividend snowball, you must look beyond the Western financial markets. The traditional 60-40 portfolio is heavily concentrated in economies suffocating under massive sovereign debt and structural stagnation. If you want to build an unbreakable inflation hedge, you must plant your capital exactly where the global growth engine is relocating. You must aggressively rotate into emerging markets and the specific asset classes that legally mandate cash flow distribution. We are talking about the massive, resource-rich economies of the Global South and the Middle East. We're looking at the sovereign financial fortresses of Saudi Arabia, the UAE, and Kuwait. We are tracking the relentless industrial expansion in China, India, Brazil, and South Africa. These nations are not printing fiat currency to survive. They are hoarding physical commodities. They are extracting energy. They are building the infrastructure of the next century. And more importantly, their equity markets are currently trading at severe, historically anomalous discounts. When inflation ravages a Western economy, consumer discretionary spending collapses, but emerging markets operate on a fundamentally different frequency. They are anchored by baseline infrastructure and raw industrial output. When you purchase blue-chip equities in these specific jurisdictions, you are buying into companies that possess absolute pricing power. If the cost of raw materials increases globally, these entities simply adjust their export contracts. The inflation is entirely passed on to the desperate buyer, while the emerging market corporation absorbs the excess margin. This is the ultimate defensive posture. You are shifting your capital away from the economies that consume inflation and into the economies that export it. But holding traditional corporate equities is only half of the structural equation. To truly lock in your multi-generational wealth, you must understand the mechanics of physical real estate securitization. You must understand the power of REITs. REITs, or real estate investment trusts, are the most violently efficient income-generating vehicles in the public markets. By legal definition, a REIT must distribute at least 90% of its taxable income directly to its shareholders in the form of dividends. They do not hoard cash. They do not engage in speculative research and development. They exist solely to acquire prime physical real estate, collect the rent, and pass that rent directly into your brokerage account. In a hyperinflationary environment, holding cash is a guaranteed loss, but holding a heavily discounted, debt-resilient infrastructure REIT is a mathematical fortress. Consider the mechanics. Commercial leases and infrastructure toll agreements are almost universally tied to the CPI. When inflation spikes, the lease agreements automatically trigger rent escalations. The revenue of the REIT surges upward. Simultaneously, the underlying physical asset, the actual concrete, steel, and land, appreciates in value because the replacement cost of building new infrastructure has skyrocketed. Your dividend yield increases, and your principal value compounds. It is a dual-engine wealth generator. But we are not talking about standard residential apartment buildings or declining shopping malls. The smart money is rotating into highly specialized physical infrastructure REITs operating within these booming emerging markets. We are looking at the exact entities funding the trillion-dollar mega projects. How do nations build entirely new smart cities, massive deep-water logistics ports, and sprawling telecommunications networks? They do not fund it entirely through government treasuries. They utilize public-private partnerships. They securitize the physical assets and allow institutional capital to provide the liquidity. You can own a fractional, legally binding share of a specialized logistics REIT that operates the automated warehouses powering global e-commerce in India. You can buy into the specific telecommunications trusts that own the physical cell towers across South Africa and Brazil. You can acquire equity in the precise industrial REITs that control the data center real estate in the UAE. These assets have impenetrable moats. You cannot simply build a competing deep-water port. You cannot zone a competing data center grid without sovereign approval. The monopoly is guaranteed by the state. The barrier to entry for the retail investor used to be geographical isolation. 10 years ago, accessing the primary equity markets of the Middle East or the industrial heartland of Asia required localized high-fee middlemen. Today, that friction has been completely eliminated by technology. Today, you can execute this exact institutional rotation from your desk, but you must use the correct financial architecture. You cannot rely on a standard localized retail banking app that only offers limited synthetic exposure through high-fee mutual funds. You need direct, unrestricted access to the global exchanges. You must deploy your capital through Tier 1 institutional-grade brokerage platforms. If you are structuring a massive global portfolio, you must utilize platforms like IBKR to access the direct order books in London, Hong Kong, and across the emerging world. Depending on your specific geographic base, you must leverage powerful cross-border banking integrations through platforms like Dime or sophisticated regional trading hubs like InnovestX. These are not just trading apps, they are your direct pipelines to the global wealth transfer. They allow you to convert your local fiat currency, bypass the restrictive domestic markets, and instantly acquire the high-dividend infrastructure shares of a foreign monopoly. You have a very specific, rapidly closing window to execute this blueprint. The institutional capital is already moving. The $84 trillion wealth transfer is actively scanning the globe for these exact debt-resilient physical assets. As this capital floods into emerging market REITs and sovereign infrastructure equities, the current extreme discounts will vanish, the prices will appreciate violently, and the dividend yields will compress. The timeline between 2026 and 2030 is the critical accumulation phase. Every single month that you delay is a month of lost compound interest. It is a month where your capital remains trapped in speculative digital assets or depreciating fiat currency. You must engineer your biannual dividend payout system now. You must lock in the 6, 7, and 8% yields while they are still available on the open market. By the year 2030, your portfolio should be completely insulated. It should be a relentless, automated machine, generating massive passive cash flow month after month, year after year, entirely independent of the panic and volatility of the Western financial system. The data is clear. The global rotation is happening. The only variable left in the equation is whether you will be the one collecting the rent or the one paying it.
We have torn down the illusions of the macro environment. We have exposed the structural fractures, the algorithmic manipulation, and the great rotation of wealth. But understanding the macro is only the first step. Now, we must build your fortress. Listen to me very carefully. The financial industry has lied to you about the fundamental definition of risk. They have conditioned you to believe that risk is simply price volatility. They tell you that if a stock goes up and down on a chart, it is risky. That is mathematically false. Volatility is just the emotional noise of the market. True risk, the kind of risk that wipes out multi-generational wealth, is the permanent loss of purchasing power due to currency debasement and the systemic collapse of toxic, over-leveraged debt. As a financial mentor, my objective is not to help you chase a speculative 50% gain in a software stock. My objective is to teach you how to engineer a portfolio that mathematically cannot be destroyed. Let us address the most insidious threat to your family's wealth: currency devaluation. You are watching the purchasing power of fiat currency melt in real time. Central banks are trapped. They cannot raise rates high enough to kill inflation without bankrupting their own governments, and they cannot lower rates without triggering hyperinflation. Your local currency is a leaking vessel. To hedge against this, you cannot simply diversify across different fiat-denominated bonds. You must anchor your wealth to the physical constraints of reality. You hedge against currency collapse by owning the infrastructure of nations that run massive capital surpluses. You rotate your capital into the sovereign fortresses of Saudi Arabia, the UAE, and Kuwait. These jurisdictions are not printing money to survive. They are extracting energy, hoarding physical gold, and funding the construction of the next century. When you own shares in their primary monopolies, you are essentially shorting the Western fiat debt system and going long on the absolute physical demand of the human race. But how do you select these specific assets? This brings us to the absolute core of elite risk management. The top 1% do not just look at a company's revenue, they ruthlessly interrogate the balance sheet, and they apply a strict, uncompromising screening process. In a high-interest rate environment, toxic debt is a death sentence. We completely eliminate any entity that relies on rolling over massive, short-term, interest-bearing loans. If a corporation generates its revenue from highly leveraged financial engineering, toxic usury, or morally compromised sectors, it is mathematically fragile. We demand absolute purity in the balance sheet. We cut out all highly leveraged, non-compliant assets completely. We only allocate capital to pristine, A-rated or A-plus rated global equities. We demand companies that own hard assets, carry zero toxic leverage, and generate pure, unadulterated cash flow. When you strip away the interest-bearing debt from your portfolio, you eliminate the mechanism that causes bankruptcies during a recession. You create absolute stability. Now, let us architect the allocation. How do you deploy the capital? You do not randomly buy 10 different stocks and hope for the best. You are building a highly calibrated financial machine. You must structure your portfolio to create a relentless, overlapping matrix of cash flow. The goal is to engineer a dividend stream that pays you every single month of the year, January through December, uninterrupted. You analyze the payout schedules of the global infrastructure titans, the Asian telecommunication monopolies, and the Middle Eastern energy providers. You weight your allocations perfectly so that the heavy distributions of February and August from one sector are seamlessly followed by the distributions of March and September from another. You are systematically mapping your cash flow. You are building a system designed to generate a highly specific 7-figure monthly baseline income by the year 2030. When your portfolio pays you massive physical cash every 30 days, regardless of market conditions, you are no longer a participant in the market. You are the master of it. This level of precision requires sophisticated execution. You cannot build a multi-generational 12-month global yield matrix using a standard retail banking app. You must treat your capital like an institutional asset manager. You need direct routing to the global exchanges. You must use robust Tier 1 platforms like IBKR to access the direct order books in Hong Kong, London, and the Gulf. If you are managing cross-border capital, you optimize your workflow using dedicated high-tier brokerage interfaces like InnovestX or Dime to seamlessly convert your fiat and acquire these international assets without suffering massive spread penalties. Execution is everything. The greatest strategy on earth is useless if your capital is trapped in a restrictive, high-fee environment. You must secure your infrastructure today so that your capital can flow exactly where it needs to go tomorrow. We have covered a massive amount of highly complex data, but I want you to step back and look at the ultimate objective. Why do we study the macro environment? Why do we obsess over balance sheet purity and 12-month dividend cycles? It's not just about the numbers on a screen. It's about ultimate financial sovereignty. It's about protecting your family from the systemic failures of a broken financial system. It's about generating a level of wealth so stable and so pristine that it grants you the absolute freedom to focus on your highest personal and spiritual callings. When your income is automated, when your risk is mathematically eliminated, and when your legacy is anchored in the physical realities of the global economy, you achieve a profound peace of mind. You are no longer reacting to the world. You are prepared for it. The wealth transfer is happening right now. The global rotation has begun. The tools are in your hands. It is time to execute.
The following is not a standard retail advisory. Treat what you are about to hear as a leaked internal operations memo from a Tier 1 sovereign wealth desk. We are executing a highly classified portfolio reconstruction spanning exactly from Q1 2026 to Q4 2030. The objective is absolute. We are engineering a portfolio that generates a massive 7-figure monthly baseline distribution by the end of this decade. We want that cash flowing perfectly, uninterrupted, from January through December. And we are doing it exclusively with assets that possess absolute balance sheet purity. We are stripping out every single equity that relies on toxic, interest-bearing debt. We demand zero toxic usury. We demand 100% pure, compliant provision. This is how you secure multi-generational wealth while maintaining the absolute integrity and blessing of your capital. To hit this aggressive 2030 target, we do not deploy capital randomly. We utilize a synchronized 2-tranche compounding engine. We divide the calendar year into 2 distinct accumulation phases. Phase 1 runs from January to June. Phase 2 runs from July to December. You buy the first group early in the year to specifically intercept their massive end-of-year payouts. You then take those exact payouts and deploy them into the second group, perfectly timing their early year distributions. It is a perpetual, closed-loop wealth machine. Let us open the ledger on Phase 1. Your January through June accumulation targets heavy industrial and energy infrastructure that distributes massive capital in the second half of the year. We aggressively allocate into Chinese energy and infrastructure titans. You are buying ticker 1088, China Shenhua. You are acquiring ticker 883, CNOOC, and ticker 2386, Sinopec Engineering. These entities are heavily discounted and fundamentally bulletproof. They control the baseline energy matrix of the largest industrial base on Earth, and they produce immense, compliant free cash flow. We pair these with the absolute apex of global energy, Saudi Aramco, ticker 2222. You aggressively accumulate these specific shares in the first and second quarters. You do not trade them, you lock them away. You wait for the global energy demand to synthesize into massive, pure cash payouts by the third and fourth quarters. Now we initiate Phase 2, the July through December accumulation. As the retail market goes quiet for the holidays, you take the massive cash dividends generated by your Phase 1 assets and you violently rotate that capital into the Middle Eastern financial and utility fortresses. We are targeting entities completely insulated from the collapsing Western debt system. We acquire shares in Al Rajhi Bank, ticker 1120. We accumulate Qatar Islamic Bank. These are institutions built on pristine, compliant capital. They operate entirely free from the systemic risks and toxic leverage of traditional retail banking. Their Tier 1 capital ratios are impenetrable. We simultaneously lock in sovereign utility monopolies, ADNOC Gas and DEWA. You acquire these late in the year using the snowball capital. By the time the first and second quarters of the following year arrive, they distribute their massive yields back to you. Do you see the architecture of the snowball? The capital never sleeps. The December yield from the Chinese infrastructure and Saudi energy instantly buys the Gulf utilities and banking shares in January. The June yield from the Gulf utilities instantly buys the Chinese infrastructure in July. Every single cycle, your share count increases. Every single cycle, the principal expands. You are effectively capturing a double-digit yield on cost within 36 months without injecting a single dollar of active capital after your initial deployments. You are weaponizing the calendar. This is how the ultra-wealthy accelerate time. Let us look at the mathematics of 2030. By executing this relentless biannual rotation over the next 48 months, you are targeting a completely self-sustaining financial ecosystem. The goal is that seven-figure monthly dividend payout, $1 million annualized unshakable distribution that flows effortlessly into your accounts. This grants you absolute freedom. It provides a multi-generational legacy built on pure, compliant assets that will sustain your family until you are 75 years old and beyond. But the window for this exact mathematical arbitrage is closing with terrifying speed. The $84 trillion wealth transfer we discussed in Hour 1 is actively hunting for these precise, debt-free global monopolies. As Tier 1 institutional capital floods into the Gulf and the Asian industrial sectors to escape Western inflation, the yields will compress. The severe discounts you see today, the ability to buy ADNOC Gas or China Mobile at these valuations, will be mathematically erased by the end of 2027. The urgency cannot be overstated. You are standing at the absolute epicenter of a global repricing event. You must open your global brokerage pathways immediately. You cannot build this precise, compliant two-tranche matrix using local, restricted banking platforms that force you into high-fee, non-compliant funds. You need direct exchange routing. You must position your capital today to intercept the dividends of tomorrow. Do not let the engineered panic of the crypto markets distract you. Let the algorithms liquidate the unprepared. Your focus must remain absolutely locked on the physical infrastructure of the earth. The blueprint is in front of you. The sovereign assets are identified. The biannual snowball is mapped. Take the capital you have locked in abstract, non-yielding digital tokens and rotate it into the undeniable reality of global monopolies. Execute the strategy, secure the purity of your wealth, and build the fortress that will protect your family for the next 50 years.
We have reached the end of the blueprint. You now possess the exact macroeconomic data, the institutional order flow, and the mathematical framework that the world's top 1% are using to navigate the 2026 wealth transfer. The divide between the ultra-wealthy and the retail market has never been wider, and it comes down to a fundamental difference in how they perceive reality. The mass market chases digital illusions. The elite accumulate physical monopolies. Let us summarize the absolute truth of the current market structure. The narrative surrounding BTC and the April 2028 halving is the most dangerous psychological operation in modern finance. You have been told to hold the line. You have been conditioned to believe that enduring a brutal, synthetically engineered drawdown is a mathematical necessity for future wealth. But while you sit entirely paralyzed by the algorithmic manipulation, gripping your non-yielding digital tokens, the smart money is actively using your liquidity as their exit strategy. Holding BTC until 2028 is not investing. It is a high-stakes gamble against sovereign wealth funds that possess infinite capital and zero emotional attachment. The longer you wait for a synthetic supercycle, the more of your actual purchasing power evaporates. You are sacrificing years of compounding, guaranteed cash flow for the abstract promise of a decentralized system that Wall Street has already co-opted, packaged, and weaponized against you. Every day you refuse to secure your profits or cut your losses, you are funding the institutional pivot. The true wealth builders, the assets that actually sustain multi-generational family offices and generate pristine, unshakable legacies, are not lines of code that crash when a central bank adjusts an interest rate. They are the physical, immovable pillars of global civilization. Real wealth is generated by the entities that control the energy grids, the deep-water ports, the telecommunications networks, and the physical copper and gold required to build the future. When you aggressively rotate your capital out of speculative crypto assets and into the massive dividend-paying monopolies of the Middle East and Asia, you fundamentally change your relationship with money. You stop hoping for capital appreciation and you start demanding baseline capital extraction. You execute the biannual dividend snowball. You buy the pristine, debt-free global equities that legally mandate massive cash distributions. You take the US dollars that the crypto whales are trying to strip from you and you lock them into the sovereign fortresses of Saudi Arabia, the UAE, China, and the broader emerging markets. By doing this, you mathematically insulate your family from the coming localized credit events and the systemic failure of Western fiat currency. You build a portfolio that pays you a massive physical cash dividend every single month of the year, uninterrupted, independent of the panic, free from toxic leverage. But knowing the blueprint is entirely worthless if you lack the infrastructure to execute the trades. You cannot capture this $84 trillion wealth transfer using restrictive, localized retail banking applications. You cannot secure global sovereignty if your domestic broker prevents you from routing capital directly to the primary exchanges in Hong Kong, London, or the Gulf. Local mutual funds will drain your yield through hidden management fees and severely delayed execution times. You must upgrade your financial architecture immediately.
If you are serious about protecting your capital before the liquidity drain accelerates, you must open an institutional-grade global brokerage account today. Look in the description below this video right now. I have provided direct, secured links to the exact Tier 1 platforms you need to execute this global rotation. You must utilize platforms like IBKR for unrestricted, unfiltered access to the global order books. If you are structuring regional capital and require seamless fiat conversion, use the links below to open accounts with robust cross-border platforms like Dime or highly sophisticated trading interfaces like InnovaX. These platforms are your direct pipeline to the physical monopolies running the earth. They give you the exact same execution capabilities as a multi-million-dollar family office. Do not wait until the market fully prices in this massive institutional rotation. Do not wait until your digital assets are frozen in a cascading weekend liquidation event. Click those links in the description, open the accounts, fund them, and begin moving your capital into the physical world. The infrastructure is waiting for you. The dividends are already flowing. All that is required right now is your decisive action. We are building a community of the most informed, relentless, and mathematically sound investors on the internet. We are cutting through the media noise and operating strictly on institutional data. If you want to survive the next 24 months and emerge by the end of this decade with a pristine portfolio that generates unshakable seven-figure generational wealth, you need to be here for every single data drop. Hit the subscribe button right now. Turn on the notification bell so you never miss a critical macro briefing. The markets are moving faster than they ever have in human history, and being late to this rotation is mathematically fatal. I want to hear from you directly. Go to the comments section below this video and tell me exactly which global monopoly you are rotating your capital into this quarter. Are you targeting the state-backed energy titans, or are you locking in the telecommunications fortresses? Leave your specific strategy in the comments. I read them all, and we will dissect the absolute best macro moves in the next video. Follow my exact portfolio reconstruction. Reject the digital illusions. Protect your legacy. Click the links below. Execute the strategy today, and I will see you in the next briefing.